Well, we think in Europe, markets may be coming, maybe getting a little bit ahead of themselves. I think ECB is certainly potentially in play this year, and we certainly do expect the Fed to start in March and will hike through the year. But we've only talked about it. We haven't started any of this, and there's a lot to do. And the Fed will have, the toughest task. They need to start hiking in March. They're likely to add the fourth hike for this year in their dot plots, if not the fifth. But they also plan to unwind the balance sheet. And there's a lot of tightening in that the market hasn't been as focused on. If the balance sheet runoff starts mid this year, runs through the end of next year, that could be $1.5 trillion that runs off. That is equal to another 3 to 4 hikes, or 75 to 100 basis points of tightening. So a lot priced in. So I think we're getting closer to more realistic, and we need to get it done. And this will have a big impact on markets. We've seen the impact on credit. I think correctly so. We had to price in more risk premium in credits. We think that's getting more attractive now. And I think this is a year where you try to buy the dips. Fundamentals are still strong in credit. Balance sheets are healthy and default rates are low. But you have to consider, Bank of England owns 7% of IG corporate market, but in Europe, ECB owns 20% of IG credit. So we remain underweight credit still, but valuations are getting much more attractive in IG credit and high yield. But we prefer high yield in this market. That's where we started to now add a little bit of risk.
Understood. And then just focusing stateside for a second, because what is happening with the Treasury curve, you're saying the market is actually failing to recognize growing structural inflationary forces. So are they just not listening to us? Because I feel like that's all we talk about.
That's all everyone talks about. But if you look at where the market is pricing, you still have, if you look at more technical measures like five-year forward, so 5-year inflation 5 years from now, still sitting at 2%. Typically, the central bank or the Fed wants to keep that between 2 and 2.5. So we're at the bottom end of the range that the Fed would want to keep. So very low long-term inflation expectations, which I think is quite interesting. We think inflation is going to be sticky this year. It's going to remain, we agree with the market. It's going to come down over the course of the year, but it's going to stay higher than the market expects. And I think there are a lot of structural changes that have gone on. Obviously the monetary and fiscal policy have been different this time. It's been obviously very aggressive, but more redistribution of policies focused on addressing social needs and targeting lower income groups. And then we have on top of that, we have the war on climate change. And so that has changed. Government's role in resource allocation is much higher than we've ever had before.